Hi, today we're going to look at the balance sheet equation. This equation is the basic concept to be understood in accounting. So what exactly does this equation state? It states that the assets in a business is equal to the liabilities plus the capital of the business. Okay, so what exactly does these terms mean? Now, assets are amounts of value or items of value owned by the business or any amount which is owing to the business. For instance, if I were to ask you what are your personal assets, you would probably say your house, your car, amount in the bank, a piece of land. Similarly, for a business, its assets would be something like land, machinery, fittings, fixtures, premises. We'll just list a few here. Inventory, the stock which it trades in, money at the bank, and also the other assets, that is the amounts which are owing to the business. That is, if the business sells goods on credit, then the customers who still need to pay the business would be referred to as trade receivables, the customers from whom we are yet to receive money for goods delivered to them. And also there might be assets in the form of prepaid expenses. Expenses such as insurance probably is paid in advance of the period to which it relates. So in that case, the payment is made, but the services are yet to be delivered, so that again becomes an asset. Now, as far as liabilities are concerned, they are amounts which are owing by the business. The most common example here would be our trade payables. When the business purchases goods on credit, then the amounts which are still due from the business to the suppliers, those are the trade payables. Just like we have trade payables, there may be amounts due for other items like expenses which are still unpaid. So those would come under other payables and is a liability. So we see here that any amounts which are owing by the business, bank loans, mortgages, anything is a liability. As far as capital is concerned, capital is the owner's equity, and it would constitute the opening amount which the owner has invested into the business, the opening capital, and also any profit gained from the business would be part of the capital, because finally profits or losses are to be taken by the owner. So the profit would increase his capital, whereas losses would decrease the capital. And we need to also subtract drawings if the business person or the owner has made any drawings for personal use, drawings of goods or drawing of cash, basically withdrawing money for money or goods for personal use, then we need to subtract that, and that would constitute the capital. So what we are saying here is the business is able to trade and own assets based on amount invested by the owner plus amounts which are borrowed from outsiders. Now an example would probably put this equation in a better light. Let's move on to the next page. Okay, I'm just going to write the equation up front on the top. Assets is equal to liabilities plus capital. Now let's just see that after every transaction which we have listed above, this equation will hold good. That means every transaction will have two effects and the equation continues to hold good at any point of time. So let's see this first transaction where they say H started a business with cash 18,000. The owner starting business with cash. Now all business transactions are recorded from the point of view of the business. So we're going to say cash is coming in to the business, so that's plus 18,000, and who has contributed the cash? It is the owner, so that would be 18,000 under capital. Okay, now the second transaction. Okay, there's a purchase of goods. Okay, goods, I'm going to write it as an asset up front, inventory. Okay, purchase of goods for cash 5,000 and credit 2,000. That means upfront we are paying cash 5,000 for some goods which are coming in, so our cash balance is going to reduce. The inventory we are purchasing two types, one on cash and one on credit, so totally 5 plus 2 we are getting inventory worth 7,000. And for the 2,000 which we are yet to pay, a liability is created, trade payables 2,000. Okay, so now we move on to the next transaction, and here we see that there is a sale of goods for cash 4,000. The goods which are going out costs the business only 2,400, so we can see the profit here. So cash is coming in 4,000. And inventory which is leaving the business is 2,400, the cost which is leaving our stock of inventory. Okay, and what's happening here in the liability? There's nothing created, but the capital, because there's a profit element of 4,000 minus 2,400, 1,600, that is added on to the owner's investment, 1,600. Okay, and then finally the next transaction, when we see paid rent 1,000 and there is a rent due of 200. So rent 1,000, when we pay it, our cash balance is going to reduce by 1,000. Nothing's happening here. There is an unpaid amount still to be paid, which is a liability of 200. And finally, what's happening to the capital? The capital is getting affected because rent is an expense and expenses are going to get down the capital. So we're going to say rent of 1,200 will bring down the capital. So any profits attributable are added on. Profits are calculated, income minus expenses. So here we have an expense, so we are reducing the profit already shown. Okay, so finally we can just add up the asset side and the liabilities and the capital side to see if our equation holds good. So here in the cash we see it comes to 16,000, and here 7 minus 2, 4 is plus 4,600. Here liability we have 2,200 plus on this side 18 plus 1, 6 minus 1, 2, we get 18,400. So this side is equal to 2,600, our asset side. And what about our liabilities and capital? Again 2,600. So this is how we see that our assets always equal to liabilities and capital for a business at any point of time.